A very good morning to all of you. On behalf of Institute of Chartered Accountants of India, I would like to welcome you all to the webinar on mandates of CAs working for local bodies under the theme Atmanirbhar Bharat of Azadi Ka Amrit Mahotsav, being organized by Committee on Public and Government Financial Management of ICAI. I would like to request CA S.N. Gupta, Joint Director, Technical Director at ICAI, to enlighten us with his words of wisdom. Welcome, sir.
Thank you, Shivani, and good morning to all of you. So, on behalf of Institute of Chartered Accountants of India, I extend a warm welcome to all the viewers of the live webinar on the mandate for CA working for local bodies being organized by the Committee on Public and Government Financial Management of ICAI. I am thankful to CA Jayant Gokhleji and CA Pratik Shahaji, who have agreed to spare their valuable knowledge with us as faculty of the program and mandate on the CA working for local bodies. They will throw light on ASLB 2 and ASLB 5 regarding cash flow statements and borrowing costs, respectively, which are mandatory to be followed by the members of ICAI while auditing the financial statement of our urban local bodies for the period commencing on or after 1/4/2022. Here, I would like to outline the role already being played by the Institute in this area. ICAI, as a partner in national building, is involved in ongoing accounting and financial management reforms in the country, in the private sector, as well as in the government. In the direction of improving financial reporting and financial management, the ICAI, as a partner in national building, is making significant effort to prescribe and support an implementation of high-quality accrual accounting framework for local bodies. This is at par with internationally accepted accounting and financial reporting standard for application by the governments at all levels. ASLB set out recognition, measurement, presentation, and disclosure requirement dealing with transactions and events in general purpose financial statement of local bodies under accrual basis of accounting. Till date, 30 ASLB have been issued by ICAI, including one cash-based ASLB to facilitate transition from cash basis to accrual basis of accounting that are recommendatory in nature at present and will become mandatory from the date specified in this regard by the state government concerned. In 2004, the National Municipal Accounting Manual was prescribed for all municipal bodies in India by Ministry of Housing and Urban Body Affairs to all state government by modeling the respective state municipal accounting manual on the same. As a step forward, the committee identified accounting standards which are conceptually similar to NMAM and can be mandated for members. Accordingly, ASLB 2 and ASLB 5 regarding cash flow statement and borrowing costs respectively were identified. The committee thought it fit to recommend that those two ASLB could be mandated by ICAI members as ASLB 2 and ASLB 5 were quite similar to NMAM requirement with some additional guidance. It may be mentioned that additional guidance both the above ASLB does not have any financial impact on the financial position and financial performance of the entity and also does not impact audit opinion. Additional guidance is more pertaining to disclosures only. Therefore, audit opinion in respect of financial statement won't be impacted. Likewise, the Council, it has also recently mandated the guidance note on accounting for investment for local bodies, which is based on AS 13 for simplification. Investment at local bodies are generally small and for a shorter tenure. Investment classification needs improvement and harmonization at local bodies to make them comparable. Both the above mandate are effective from 1st April 2022. For the ease of various stakeholders and users, the committee has also issued publications ASLB at a glance, which covers ASLB in a simple language to enhance their outreach amongst prospective users and concerned authority. Further, to the above, we have brought out an e-book on the role of professional accountants in public financial management to create a basic level of understanding amongst the readers, particularly the accountants in respect of public financial management. This area not only require excellence in the field of accounting, audit, law, governance, etc., but also require a good understanding on how government work and what the citizen needs. The ebook is very lucid language, summarizes the public financial management system in India, public expenditure and financial accountability and opportunities available for professional accountants. Our certificate courses on public finance and government accounting has been noticed by the policymakers, and state government has started including it as a criteria in assignment allocation. We are presently running 18th online batch of the course. We have also introduced online self-paced courses on public finance and government accounting on DLH platform, consisting of video recordings of certificate courses lectures that may be watched anytime, anywhere. There is no fee for self-paced courses for ICAI members. Chartered accountants are being engaged by various local bodies for various tasks such as maintenance of books of accounts, auditing, budgeting, financial planning, tax planning, and statutory compliance, etc. The idea behind mandating these ASLB required to be complied with while auditing urban local bodies is to improve the financial practices that are being followed by urban local bodies and empowering urban local bodies to take a step in the direction of becoming a self-sustained and self-reliant. I hope that you all would be benefited from the deliberations of this live webinar. I once again wholeheartedly welcome all of you in this webinar who are learning online through this webinar. Wish you all a happy learning. Thank you very much. Over to you, Shivani.
Thank you very much, sir, for your enlightening words and throwing light on the theme of today's webinar. Now let me introduce the faculties for the day. Our first faculty is CA Prateek Shah. CA Prateek Shah is a partner with Deloitte Haskins & Sons and Sales LLP based out of Mumbai with over 17 years of experience in professional services, with 2 years of corporate experience in manufacturing, mining, automobile, and IT sector. Major part of his time has been spent in accounting advisory services and has led various assignments under various accounting frameworks, which include Indian GAAP, IFRS, US GAAP, and Ind AS. He has successfully led assignments for Mahindra & Mahindra, Hindalco, Adlabs, Clariant Chemicals, Future Consumer Group, etc. He is also leading the IFRS 16 practice for India. He has spent his initial years in the audit practice across manufacturing and service sectors. Sir is also accredited IFRS trainer for Deloitte and is also a faculty with the Institute of Chartered Accountants of India for IFRS, Ind AS, and various other forums, including corporates. Sir is a chartered accountant, certified public accountant, and commerce graduate from Mumbai University. Welcome, sir.
Thank you. Thank you, everyone, and thank you, C.S.N. Gupta ji. I think, I hope I'm audible. Perfect. So, I think, Mr. Gupta ji, I want to just first highlight the efforts taken by the committee under the leadership of the chairman over the last 2 years. And I know I was a part of the process and how rigorous the process was to ensure that we try and release as much as expected drafts and standards in a year. It was a commendable effort, and then that showed how he was trying to push the entire government machinery also in the direction to approve and get this standard used by people. And hence, it's an effort which is taken in the right direction and will definitely help our fraternity to ensure that we are able to get people on the accrual base of accounting in the local bodies area. Because of course, we know that accrual base of accounting will help you get the right numbers, right disclosures, and right presentation of where the local body is heading towards. The important part is the consideration and the effort which was taken by the entire committee to ensure that the standards were made lucid, were made easy to adopt. All the factors which were there in the international standard were not adopted blindly. Each and every area was assessed, analyzed, and only then it was agreed or disagreed to add it in the standard or keep it out. So I think that was a very important step that was taken. With that, I think I would like to even welcome and wish a good morning to every other member who's joining this webinar. We are going to talk about two specific elements today. We'll talk about the cash flow statements and the borrowing cost. As I think rightly mentioned by CSN Gupta ji, the cash flow statement will have an impact in terms of an additional disclosure, which only helps disclose in the right form what the overall cash flow movement has been, and the standard very clearly prescribes. We as chartered accountants would have done this for our corporates, and a similar guidance is provided in case of this standard as well. It's more of a disclosure. So the second standard, which is around borrowing costs, that will have some amount of impact in terms of how the numbers could change. And we'll talk about those two standards in the next 45 minutes or so that we have to ensure we have a very fruitful discussion. With that, I'm putting across the screen for discussing the cash flow statement. And let me know if the screen is visible, and we can then start.
Yes, sir, it's visible.
Super. So I think in terms of the cash flow, the rules are pretty simple. The guidance is also pretty clear in most of the cases. However, as I always say, the devil lies in details. Once you start implementing it at a greater level, you will realize that the challenge to identify certain transactions and ensure that they are accounted or disclosed or classified the right way becomes a very important task, and judgment for us as a professional has to come in. But having said that, one of the important part that comes to me as a challenge in terms of cash flow statement is the entire process of preparing financial statements. And I'm sure it's not coming to you as a surprise, but when we look at any audit or a financial statement preparation and audit and then reporting process, the entire bulk of the time goes only in preparing the financial statements. When I say financial statements, it's the balance sheet, P&L, equity statement, and the related notes and disclosures. Cash flows is something which is picked up at the end. And I can tell you from an SEC standpoint, SEC is the US equivalent of SEBI. The number of restatements which have happened in cash flows over the last 5 years has been enormous. The reason is people do not focus so much on the cash flow statements. The method by which it has to be prepared is not clear. I know of n number of clients, and all of them to me use a different method. I believe cash flows can be linked to the balance sheet. There are, of course, adjustments which are required to be done, but the basic cash flow can be by default linked to the balance sheets year on year, because essentially it's nothing but the movement of balance sheet that has to be reflected by way of transactions, and then you do specific adjustments that have to be shown as adjustments between the cash flows. So I think that's the most important part when I talk about a cash flow statement preparation, where you automate the process and ensure that it gets driven through the process of preparation of financial statements and is not something which is put at the end of the entire reporting process, which makes it more prone to errors and different challenges around it. With that, I think I'll just talk about some of the main definitions which are used in the standard. And again, these are very similar to what we use under Ind AS, or we use under IFRS, or we use under IPSAS. So hence, the application, the understanding has been made very, very consistent. And that's again something which I would really applaud the committee that who have spent time preparing this accounting standards. So the important elements which have to be discussed is cash equivalents. What are the three activities, which is operating, investing, and financing? Now, these are the broad elements which are required to be understood from a cash flow standpoint. Cash is, of course, what we know of balances lying in hand or in banks, but cash equivalent is something where judgment is used. And again, the standards have been made very, very clear here that it is only looking at those investments, right, which are short-term, and short-term has been defined as a period of 3 months or less at the point of initial investment. Now, this is an important element because I have seen errors coming in this area, and it talks about the initial date or the acquisition date. So let's say you have gone for a investment for a 2-month period, and you have been renewing it every time. That could still qualify as a short-term cash equivalent because the initial period is around 2 months. And that's where it says the focus on the initial acquisition date is important. You shouldn't be focusing on the date which comes at the balance sheet. So let's assume you have done a 6-month investment, which has been done in the month of, let's say, November, and we are doing a 31st March account. On 31st March, the balance period is around 2 months, because if you do December, January, February, March, 4 months have elapsed. In April and May end, the investment will mature. So can this be used as the basis of that on the balance sheet date, this is cash equivalent? The answer is no. That's why it very clearly says it has to be looked from the acquisition date and not from the date when you are reporting. That's a very important point in terms of cash and cash equivalents. The cash flow, as we know, is divided under three activities, that is operating, investing, and financing. So operating is those which are related to the principal activities of the body. Investment is where you either acquire or dispose long-term assets, and financing activities are ones which result in this either combination of the equity or there are borrowings. So this classification becomes very important because as you know, cash flows are divided into three sections: operating cash flows, investing cash flows, and financing cash flows. And unless this classification is done right on day one, there are huge chances that it would continue year on year, because once the format is set, generally people do not challenge the format that is used from year one. Integral part, these cash flows are an integral part of the financial statements. They are not a separate disclosure which is voluntary. When you look at a cash flow, so we talk about the four basic financial statements, which is the balance sheet, P&L, statement of equity, and cash flow. So cash flow becomes an integral part of the financial statements, and the notes to accounts become an area or an element which explains the entire part in terms of what the main financial statements talk about. We talked about how the classification happens in the earlier slide. Now, when we talk about method of cash reporting, there are generally you show all the elements as gross, but there are two broad methods of computing a cash flow. One is the indirect method, and second is the direct method. Now, when you talk about the indirect and direct method, generally I have seen, I've not generally, I can say almost all places I have been to, they use the indirect method because, of course, it's an easier way to compute your cash flows. And as I said, you can automate the process because you compare the balance sheets between 2 years and come with the answer of what the profit or the cash flows for the year should be. But the standard also allows you a method called as direct method, where you actually look at the gross receipts and payouts which have happened in the year, which is an extremely difficult process. The systems and the processes around it will have to be very robust to ensure that the information which is reported is absolutely accurate in terms of the preparation. Now, I know IASB was in the process of mandating direct method only and scrapping the indirect method, and this has been on the cards for some years, but I have not heard any movement. So that you can realize how difficult it would be to use a direct method, and hence it has not been mandated, and people only use the indirect method. Also, you can report the cash flows on a net basis. And when I say net, if there are transactions between the same customer, you can net it off. Purchase, and then purchase returns, you can net it off. You do not need to show it in its different elements, but there are some key elements. Example, let's say specific transactions in a year of major equity issuance or major acquisitions. Those you have to show separately because the balance sheet would not show them, and you'll have to show them separately on a gross basis. When you come to transactions on foreign currency cash flows, again, from an ASLB standpoint, I don't see this having a significant impact, but it's something that could be important in terms of understanding as our government grows, because there could be some donations, there could be some money coming in terms of foreign currency. And generally, the way you look at it is you record this cash flows only in the exchange rate at the date of the transaction. Now, we know that people use an average rate for a quarter, for a month, and then those have been used consistently. I think those bases can be used even for cash flows under ASLB. But however, the important part is whichever format you use has to be used very, very consistently in the overall picture. Interest and dividend, again, this is an area where there are significant challenges which we have seen over the years, because if you look at Ind AS, there have been different guidances compared to IFRS. But in an Indian GAAP, Ind AS, and even our ASLBs, we have made it very clear that interest paid, that's an expense on bonds and debentures, should be a part of financing activities unless you are in the business of lending money. Otherwise, it's always a financing activity, and interest and dividend received should be part only of investing activities. So to some great extent, we have made it consistent with what we do under Ind AS and made it easier by having a rule for our application from a ASLB standpoint. Now, again, there could be subsidiaries, joint venture, associates, and joint operations. All of this could have a different challenge when it comes to incorporating cash flows. Again, in ASLBs, we have generally not seen a significant consolidation event happening because all of them mostly are standalone. However, when the main accounting would happen at the central level, let's say the regional ASLB, which will have a lot of offshoots, there could be a challenge. We are still evaluating what amount of complexities could come in from an ASLB standpoint. In corporates, we have seen this time and again, but we still thought that the guidance around subsidiary, joint venture, associates, and joint operation should be given in the standard, because exceptions could be there. And the way we are seeing the growth of government sector and the involvement of them, this is an area which could really grow fast. And hence we thought we will incur the elements. So when it comes to subsidiary, we use the same method that is used for consolidation. We use the line by line consolidation even from a cash flow standpoint. Currency could be a challenge, but again, from an ASLB standpoint, we don't see that. So I have not factored that particular element. Joint venture associate, which we do the equity method, you mainly include the accounting from an equity investment standpoint or what distributions you have received. Only those are factored in the overall cash flows. You do not need to do a line by line elimination or a consolidation, because that's the way we even account in the balance sheet. So that's a pretty simple one. From a joint operation standpoint, you only include the share of the entities or the local bodies cash flows, which makes it easier in terms of how do you account for it. So as I said, I don't believe this will warrant a lot of application in practicality from an ASLB standpoint. However, as I said, we believe this growth potential, and hence we talk this needs to be covered because it could be applied at any point in time, and we don't want people to use any other guidances. Now, this is an important element in terms of non-cash transactions. Now, there could be many situations where a transaction happens which may not be in a pure cash flow form. Example, an acquisition which has happened only by equity issuance. No cash has exchanged hence. And when we're talking about a cash flow, it becomes important to disclose what non-cash transactions are. And this is again consistent to all global standards. Any significant non-cash transactions has to be disclosed separately below the cash flow, explaining in detail what the transaction was and why it's not reflected in the cash flow statement. So this is an important element from a disclosure standpoint. Other disclosures, a lot of commentary will be required. You also need to disclose the cash and cash equivalent summary of on what basis the cash and cash equivalent has been classified, disclosed, assessed, and of course a reconciliation of how it is shown in the balance sheet. Now, there's also an important element that comes up when you show the bank overdrafts. Bank overdrafts are generally shown as a part of cash and cash equivalents. And again, I'm repeating, the standard is very clear on this. It gives you very clear guidance, because generally bank overdraft is used as a cash and cash equivalent because unless it becomes a borrowing when it goes into financing activities. But overdraft generally has a positive negative balance. And only in real terms, when you show a bank OD account in your notes disclosure, is something which will show as a part of your entire disclosures from a cash and cash equivalent standpoint. Now, coming to the standard, the ASLB has been very fair in terms of the disclosure. So if you look at the standard, I don't know how many of us have actually read the standard on ASLB 2, but when you look at the standard, you will be very clear in terms of how the disclosure has to be. So last two appendices in the standard actually show how indirect cash flow or a direct cash flow would appear and would look like, and that has been added in the standard itself. So if you look at it, you can download from the website. You will come to know how the cash flow would be required from an ASLB standpoint, and that's something that you can refer to ensure that whenever we are doing it from our client standpoint, it is something which is very relevant, and we are up to the mark in terms of the disclosures. Before I end, I just want to reiterate again the challenge in preparation and population of cash flow. There are many reasons why cash flows do not tally. What are the areas that could actually bring in a lot of challenges? Actually, currency translation differences. There could be movements not captured in the formulas. Formula errors becomes a very important, because once it has been, it has entered the cash flow format, and if it's not identifiable easily, you will not be able to challenge. So it's very important to have cross checks at all levels to identify if the cash flow is going wrong at any point in time. Reconciliation of cash and cash equivalents with the opening closing becomes very important. And last but not the least, the adjustments which are required, let's say the capital movement, working capital movement, or any specific transaction, one-off transaction which has happened, which may not be really visible, and completeness of those is an important element from a cash flow preparation standpoint. I think these are the elements I want to talk through, and probably I'll just take a pause for a moment, and if there are any questions before I jump onto the second standard in terms of borrowing cost. Any questions? Happy to take. Okay. Believe there are no. So with that, let me just get on to the other standard that we have, which is on borrowing cost. Now, when I talk about borrowing cost, again, it's very simple. Can you see my screen on borrowing cost? Or not yet? Okay. Now is it visible? Okay. Now, borrowing cost is a standard which was introduced in the overall scheme of accounting standards in a very, very different concept. Now, it's important to understand why the standard was introduced, because there are a lot of costs which are incurred. And when we talk about a borrowing cost accounting, generally it was all charged to P&L. But in line with our accounting treatment of long-term fixed assets, right, or PP&E as we call it, when we capitalize a cost, and then that cost is spread over a larger period by terms of depreciation, the moot question which was asked was, why shouldn't be a borrowing cost which goes specifically or indirectly for capitalization of a fixed asset be capitalized along with the fixed asset and then amortized over the period rather than taking it upfront. So this was the moot principle behind the standard, and that's why the standard was introduced. Now, coming to and having to speak about it, the standard started with a very simple principle in terms of only the specific acquisition cost in terms of specific borrowings should have been capitalized. But then there came a concept which was an avoidable cost concept, which is mentioned in the standard again, and that was something which was used. And I'm being very candid. There are multiple schools, school of thoughts available on this, where people have a different thought. But the principle that I follow, and I believe that's the right way to do it, is using the avoidable cost concept. So what I mean by the avoidable cost concept is that you should not restrict only to the specific borrowing cost, but you also need to factor the other borrowing costs, which are generic, maybe working capital loan or a generic loan which is being used for the purpose of this acquisition. Now, the common argument I hear is, hey, look, I had taken this borrowing, but you can see this entire borrowing is only going to fund my working capital. It's not a single rupee has been paid from this account to my capitalization of a factory building or my new plant which I'm building up. So why are you challenging, and why do you want me to capitalize this? Now, I'm sure you can resonate this with many corporates have come to me with this argument. The only point I make to this is that's the reason the standard says this is to be based on avoidable cost concept. And what does that mean is that if, and it's a presumption the standard made or makes, that if you were not to make this particular investment, right? If you are not to make this particular investment in the factory building or the plant that you are making up, the cash which you are using from your own funds, I'm saying not from the borrowed funds, but from your own funds, that would have gone to pay the loan and you would have still paid a lower interest. Now, this is the avoidable cost concept which the standard talks about. And hence, I believe it's very fair to not only capitalize the specific borrowing cost, but you also need to capitalize the borrowing cost, which is generic. So this is a school of thought. I very strongly advocate this, and I go by this principle. As I said, the standard also talks about it. So I get my clients do this at all levels, and I don't believe ASLBs should follow anything differently around this. So what is the borrowing cost? I think borrowing cost can be capitalized only when there's a qualifying asset and the borrowing cost is being actually incurred. So I think these are the two elements which need to be made, and borrowing cost can be put on at the acquisition cost, acquisition time, or during construction, or when any other asset qualifies as a qualifying asset, or the borrowing cost be charged to P&L as and when incurred. So again, if it is a specific borrowing cost, you have to capitalize the entire amount of that interest on the specific borrowing. However, if it's not a specific, you will use a generic formula, which we'll go through in the slides to come, and I'll explain how it is to compute it. You can work out a average capitalization ratio, the capitalization rate, and that you apply to the overall cost. And that is something which is charged to your asset base. Now, there are some terminologies as a borrowing cost. It's interest and other costs that is incurred in connection with the borrowing. So it's not just interest. Let me mind you, the standard talks about 5 specific elements of what borrowing cost could be. Interest and then related costs are, of course, one part of it. But there's also an important element which has been brought out. One is you also incur an initial upfront fee, right, for getting a borrowing. And then the banks generally net it off with the amount that they pay you. So let's say you're taking a 5 crore loan and the bank is charging 5 lakh rupees as an initial fee. The bank pays you only 4 crore 95 rupees back in your bank. So the 5 lakh rupees has been charged to your friend. Generally, we end up recognizing that 5 lakh rupees as a cost on day one, but it is effectively a cost which has to be recorded over the tenure of the loan. And hence, you have to be mindful that even that cost is factored as a part of the borrowing cost, which actually brings your effective interest rate a couple of notches above than what it actually is. And qualifying asset, again, is an asset that takes a substantial time to get ready. Now, the standard doesn't qualify or define what a substantial period of time is. However, by rule, I've seen that generally people use a year as a benchmark. Some people have taken a 10-month period as a very close cutoff. But generally, I stick to a rule of 12 months and above, which is a substantial period of time, which makes it even consistent for application purposes. So how do you recognize borrowing costs? When you are computing a borrowing cost and you're having a qualifying asset, that amount of borrowing cost to be charged to the asset and then depreciated over the period. All other borrowing costs will be charged to P&L as and when that is incurred. Now, these are the rule of thumbs. Mind you, again, from a disclosure standpoint, there are very, very strong disclosures, which makes it very easy to identify what are total borrowing cost, how much has been capitalized. And it's easy for a reader to reconcile all of the expenses with the loan that you show in a balance sheet and how that amount has been reconciled. Because when you capitalize the borrowing cost, what generally happens is the interest cost which you show in your P&L doesn't very easily correlate with the percentage of loan that you show in your notes. Let's say you show that you have taken a loan at 12% over the year, and it has been almost for the full year because you give all this information. It's easy to compute. So the amount which you show in your P&L doesn't correlate to the 12% of the loan amount outstanding, and hence it's important to disclose as a part of your fixed assets note what amount has been capitalized. So then amount in your P&L and the capitalized amount, that is something which comes closer to the 12% or the actual interest rate, and readers can actually make sense of what has been done in terms of your overall disclosures. Now, I'm writing the solution also together. I'll talk about the fact a construction company has incurred expenses for the acquisition of a permit allowing the construction of a building. It has also acquired equipment that will be used to construct various buildings. Can borrowing cost on the acquisition of the permit and the equipment be capitalized until the construction of the building is complete? The answer is yes for the permit, which is specific to one building. It is the first step in a wider investment project and is a part of the construction cost of the building, which meets the definition of a qualifying asset. So here, the permit is not having its own value. The permit has a value only along with the building, and hence the building, which takes a substantial amount of time, we can capitalize this cost. When it comes to the equipment, the answer is no, because the equipment is going to be used for not just that building, for many other buildings. It's a normal PP asset for you, and it is something which is ready for its intended use as you have bought it. So it's not taking a substantial amount of time, hence it's not a qualifying asset, and accordingly, you won't charge the borrowing cost on that. Are we okay till here? Any signs? If you just even have a thumbs up, I should be okay with that. Or else I'll assume we are fine with the concept so far and move ahead. Okay, that's fine. So now, what are the borrowing costs that are capitalization eligibility meeting points? So one is, of course, the interest, which is calculated on an effective interest method. The reason I say effective interest method is because I mentioned it in the first slide itself, that you are paying a cost for getting a loan, which is called a loan processing fee generally, that is also required to be charged over the period under the effective interest rate method. And hence, I use effective interest and not only the pure interest you pay to the bank. The initial period cost has to be added to the overall value of the cost that you bear. Any lease liability, so when you record for a lease as an operating lease or a finance lease, the interest cost which you bear also has to be shown as a part of your borrowing cost. And third, which is very important again, is an exchange difference. And this is a very interesting point. I'm sure you would know that if you take a borrowing in a foreign currency, the interest rate is significantly lower. So let's say you get a borrowing in dollar terms, you get an interest rate of around 3 to 4%, where for a similar loan, similar amount in the Indian context, you get a rate at around anything between 9 to 12%. Now, so this difference of between 3 to 9, which is around 6%, how this that to be treated? The standard allows that because this is an effective interest rate difference, because you are taken in a foreign currency, this amount also can be capitalized as a part of interest cost. But there are, of course, complications in nuances in terms of its computations. But the standard appreciates and acknowledges that this is a difference that you would have borne otherwise if you had taken the borrowings in your own functional currency, and hence that amount also can be capitalized. Now, the important part again here is on the qualifying asset. You need to look at the specific borrowing cost to be capitalized, which is always 100% of the cost, and you straight away capitalize it. However, there are some times when this loan, which has been put to, you may not use the entire loan as a single stretch while you have been awarded the entire loan and it's sitting in your bank account. So the excess amount could be sitting in some investments. The investment income in that case also has to be reduced from the overall borrowing cost that is capitalized. General borrowing cost, as I said, it is not a specific loan. It is a loan which is coming from other working capital loan or a very generic loan or a free flow financing funding capacity which you have taken from a bank and which is available. So there you work out an average capitalization rate, and that you multiply with the expense incurred for the period when the expenses have been incurred, and that amount is capitalized and of course reduced from the overall expense that you have already booked in your P&L. Now, the capitalization rate is an important part and element of the entire computation. How do you do it? It is you take the total overall general borrowing cost for the period and you divide that with the overall average. So I'll let me just straight away take you to an example to explain that. Beta Limited had the following loans in place at the end of 31st March 2002. Okay, there was an 18% bank loan of around 100,000, and there is a 16% term loan of around 300,000. For simplicity, I've kept the opening and closing numbers same. And there's also 14% debenture for around 200,000 as at the closing date. Now, the 14% debenture was issued to fund the construction of office building on 1st July 2001, but the development activities has yet to be started. On 1st April 2001, Beta Limited began the construction of the plant, being qualifying asset using the existing borrowing, which is the 18% and the 16% bank loan. Expenditure drawn down for the construction was 500,000 on 1st April and 2.5 million on Jan 2002. Now, when you look at the elements of the loan, the debenture has been taken for a specific purpose, and hence it's a specific loan. When you talk about a specific loan, you will not factor that when you're looking at the capitalization rate from borrowing, because that is only for the generic loan. That's the first elimination that you will do. Now, coming to the capitalization, how will you work it out? There's 18% of 1,000 divided by 4,000, which is the overall loan balance, plus 16% on the 3,000, which is again on 4,000, which is the overall balance. And hence you would come with an average rate of capital, which is 16.5%. Now, this 16.5% you will multiply with the amount you have spent. So as you saw earlier, 500,000 were used for the entire year. So 500,000 into 16.5% plus 2.5 million, which was drawn down only in the middle of the year in the last 3 months. And hence you are using 16.5% only on the 3 months of the 12 months. And hence of the total interest that you will pay, you will capitalize only 1.85 thousands as a part of your borrowing cost. Now, this is generally a very simple computation because looking at the corporates, there are few loans that have to be worked on for. But when I have looked at a situation where there are large corporates, there could be 10, 20, 30 loan balances going on, and this computation becomes as complex as any other thing. And hence, at those places, this is a challenge. At ASLB standpoint, I don't believe this is going to be a challenge in the sense, again, most of them are very, very restricted funds in terms of availability. And also, most of the cases I've seen that there are only specific loans which are taken, and hence I believe that may not be a challenge. Having said that, this competition will have to be kept in mind, and we need to work out on this basis to ensure that the capitalization is done the right way. Again, I said it's a matter of competition. There needs to be documentation which is robust in terms of explaining this. Also, the important element which has to be kept in mind, again, from a corporate standpoint, it impacts ASLB may not be as much. The impact on a standalone level and a console level could be different. So let's take an example. A subsidiary has taken a loan at 16% and given the same loan to the parent at 18%. And the subsidiary has just passed the loans. At the subsidiary level, there is no borrowing cost, which has been capitalized. But at the parent, there could be, which is 18% on a standalone basis. But when it comes to the console, at a console basis, the entity has taken a borrowing only at 16% and not 18%. And hence, that 2% differential has to be reduced from the overall borrowing cost. And this is where the complications could come in when you do a borrowing cost. And then there is an intra-entity borrowing cost challenge that comes up in this scenarios. Again, I repeat, from an ASLB standpoint, I don't see a significant challenge, but something needs to be kept in mind for forever as the growth of this local bodies happen. Commencement, and this is an important milestone. As I said, there are two elements. You need to incur borrowing cost, and there has to be capitalization, which has been working. So there are three elements which need to be met, and only then you are allowed to capitalize the borrowing cost, which is the expenditure for the asset should be incurred. The borrowing cost should be incurred, and activities that are necessary to prepare the assets for its intended use are in progress. Unless these three elements are in place, you will not be allowed to capitalize the borrowing cost. Now, this is an example. Again, we'll do it together. In March of a year, entity ABC ordered 4 aircraft from a manufacturer for delivery in the period YO to Y4. There's a down payment for each aircraft upon signing the contract. The remaining payment schedule for each aircraft varies based on the expected delivery date for the individual aircraft. Entity ABC funds all payments with bank borrowings, right? That's where the trigger should immediately come, and the borrowing cost could be an implication here. The manufacturer started production planning for the first aircraft, including ordering parts from suppliers, soon after the agreement was signed. The plane physical assembly takes place within the last 6 months prior to delivery. However, the production of the individual parts, either at the manufacturer or the sub-suppliers, takes place up to 24 months before delivery. Entity ABC received information from the manufacturer that the production of parts for the first planes started in February 2008. No action has yet been undertaken by the manufacturer for the production of other 3 aircraft. Entity ABC designated 1 Jan 8 for the early adoption of entity, or in this case, ASLB as well. So can the borrowing cost incurred by entity ABC be capitalized? If so, when does capitalization start? The answer is the aircraft is a qualifying asset because it is taking a substantial amount of time. It doesn't matter whether you are making it or you are getting it done to somebody else. The accounting implication should be fairly same. The construction is taking a substantial amount of time, around 2 years. The borrowing costs incurred by entity ABC are therefore capitalizable. Entity ABC incurs expenditure on the aircraft by making a prepayment. It also incurs the borrowing cost as a bank borrowing was obtained. Capitalization of the borrowing cost starts when the manufacturer starts the construction activity. The construction activity in production of parts started in Feb 2008, but only in relation to one aircraft. The borrowing cost incurred in relation to the one aircraft can therefore be capitalized from Feb 2008. The borrowing cost incurred on prepayments made in relation to remaining aircraft are expense until the construction process begins. Now, this is an important differentiation which has to be made. While you ordered for 4, the process is only started for 1, and hence the cost for others will be charged to P&L. Only for one aircraft which is under construction, you'll be allowed to capitalize the borrowing cost. Now, as I said, these are nuances which will come through, but as and when you apply, judgment will be required. As I said, the standard is still very much clear. We'll give you clear guidance, but still our judgment as professionals and chartered accountants will be applied, and we'll have to take the right judgment in terms of when to capitalize and when not to. Now, this is again an important part. When should you commence? So there are 4 dates given here, and I'll tell you what was the right date. X Limited is commencing a new construction project, which is to be financed by borrowing. The key dates are in May 15th, the loan interest related project starts to incur because you have agreed with the bank and the bank has reimbursed or disbursed the loan to you. 2nd June, so May, June, in the month of June, technical site planning commences. 19th June, expenditure on projects starts to be incurred. And 18th July, construction work commences. So there are these 4 dates. So 15th May doesn't matter because even the loan has been started. The interest you are paying, it is not something which is the other conditions are met. Technical site planning commences. This is the planning. This is not the overall commencement of the activities. 19th June to me is the date. It's the date when the expenditure started. 18th July is only when the construction processes commences. But that's an advanced activity of the overall expenditure. So hence the date should be 19th of June, where the expenditure of the project has been started. Any which ways you are looking at the loan which has already been paid. That condition is met. And any which ways we are going with the third assumption that this project is going to take some significant and substantially long amount of time, which is beyond a year for its construction, and hence all the 3 conditions are being met here. Now, this is an important point because you have started commencing or capitalizing borrowing costs doesn't mean you will continue doing that at all points in time. Hence, when you do it is an important element, and when you should stop is also something which has to be kept in mind. So you look at a situation during extended periods in which the active development is interrupted, you will have to stop capitalization unless the delay is purely temporary and by an external event. Interruption has been caused by technical or legal obstructions that are typical part of the process. So let's say in real estate, you may not be able to do much unless the some of the government approvals come in, and that's a part of the process, or a period when substantial technical admin work is being carried out. So you are still saying it's stopped, but significant amount of work is done. Unless one of these 3 conditions is being met, you will not be allowed to capitalize borrowing costs if the work for capitalization has been suspended. Now, this is an area of a lot of contention because this really, and especially for startups, it really shoots the P&L in the foot, because rather than capitalizing this cost of borrowing, you will start hitting the P&L, and it affects your bottom line in a very adverse manner. Hence, it becomes a very important part from, and again, ASLB, where the profit margin are going to be very, very thin. You'll have to be very, very circumspect and articulate in terms of when this clause should be applied and how it should be. Again, because most of the things will be driven by government, I believe in an ASLB, this element could be of more relevance than a corporate, and hence it's an area where you have to keep our ears and eyes open in terms of its application. Last but not the least is where you have to actually stop your capitalization. That's essentially we are saying the asset is ready, or the borrowing cost is stopped being incurred. And I think that's where you would say, I will stop the capitalization process and I would not want any further capitalization to be added here. So this is an important area and judgment because again, if you talk about a 3-4 year process where capitalization takes place over some long amount of time, it becomes a normal process to capitalize, and hence it will be important for us as accountants, auditors to keep in mind when to stop this and have a real stop date and review this very, very rigorously, meticulously, and on a periodic basis to ensure that the wrong accounting can be avoided. Else, it becomes a challenge in terms of identifying and then reversing it. So this was the last part in terms of the accounting implication. This is one example I just pick up. S Limited, a real estate company, gives immovable property on rent. It has completed on May 31, year 1, a commercial complex consisting of various offices that could be rented out. It expects that the commercial complex will be completely rented out by June 30. So June, within a month. However, due to adverse market conditions, only 10% of commercial complex will be rented out by its reporting date, 31st March 2022. So it did not take 1 month. It actually took almost a year to get rented, and that only 10%. S Limited wants to capitalize the eligible borrowing costs incurred over 31st March 2022. Now the answer here is clear. You will have to stop the capitalization when the asset is ready, which is May 31. Because the asset is ready for its use, you are not incurring any expenditure in terms of capitalization, and hence it doesn't make sense to capitalize further amount on this. So this is where the bright lines are very clear. However, as I said, in real life, it may not be so black and white, and then you'll have to apply judgment. 1 month here and there doesn't matter, but it cannot be, of course, a period which is significant in terms of the cost overall. So that's an area we have to be mindful of. In terms of disclosure, I even touched about this earlier, but what the amount of borrowing costs have been capitalized is important, and how the capitalization rate has been derived is also an important disclosure. The accounting policies, of course, have to be very, very transparent around this, how it's done, and how the amount has been computed. So these are the nuances in terms of borrowing cost. It becomes important from a standard setting standpoint to make it easier, which it has been. Again, it's not something which is difficult and a new concept. It has been there under Ind AS, under Indian GAAP, and we have been using this historically. So it makes it easier for usage and further application. As I said, this is but a standard which will have impact on the numbers in terms of there could be deferral of this cost if capitalized. If not, it will have an impact on the P&L. So these are numbers impacting standard, unlike cash flow, which is only a disclosure standard, and hence will require more focus and more attention from a ASLB standpoint. I think with that, I just end the session, and I'll probably open the floor for any questions for next 5 minutes before I hand over to Mr. Jayant Gokhale for any other session, the other next topic.
Thank you, sir. So we have received few questions from the members.
Yes.
So first question is, in Tamil Nadu state, the local body's official says no need of CA certification, nor CA audit required for any projects. Please advise what are all the scope in Tamil Nadu local bodies for a CA who got certified under Public Finance Accounting course by ICAI?
No, so this is something different, not related to the standards as such, but I would believe this is a matter of time. And as I think the joint director at the beginning mentioned that they are coming up with some guidelines around certification being an important part of working with those entities. It's a matter of time, and those licenses will be required to become eligible even to make a bids for those local bodies. And hence, my recommendation would be to get those licenses in place to ensure that when the time comes, we are ready to deliver, and we do not get disqualified in any other element there.
Thank you, sir. Next question is, as almost all of the tenders ask for past experience, how can we get work?
Now, that's a chicken and egg theory. I think there'll be a first time always. What I generally do, and I'll be very candid about it, and I also did my first IPSAS. IPSAS are the standards on which ASLBs are based. I did this IPSAS engagement around 4 years back. And it was, as I said, my first IPSAS engagement. It was not for India, for some other country. And I did not have any experience on IPSAS. But the way I put confidence to the corporate client there or the government client there was by explaining that I know IFRS, I know US GAAP. I talked about the differences between IPSAS and IFRS US GAAP, and said these are the differences which are not difficult for me to comprehend and explain to you. That's how I got my first engagement done. And after that, it has been rolling. So there will have to be a first. You'll have to come up with a way of explaining. There may not be a prior experience from an ASLB standpoint, but I'm sure we have done work on accounting standards, and that is something that we can leverage on. You are on mute again. You are on mute.
Next question is, why municipal corporation council are not publishing their financial report in local newspaper? Why deadlines are not prescribed for audit of these local bodies? Why regulator is not appointed to scrutinize the account of local bodies? Local bodies must publish their financial or quarterly and yearly basis report as is compulsory for listed companies.
I think I would request you to take this up with the committee, and then if any recommendation can be made to the government on this. It's a valid question. I know of local bodies spending 2 years to come up with the financial statements. This is something which should be picked up by the committee and taken to the government. It's a valid point.
Okay, fine, sir. Next is, internal and concurrent audit system can be introduced in local bodies like municipal corporation, council, Gram Panch, Zilla Parishad, road transport officer, district civil hospital, district court, collector's office, state road transportation corporation, etc. This will provide great transparency and early stage detection of fraud. Then, Next question is, sir, normally borrowings are taken as a bucket to meet many projects and working capital. Can interest be apportioned to capital assets and revenue expenditure?
So we talked about that. We talked about the concept of avoidable cost. We talked about the concept of first allocate even if it's a generic borrowing in buckets, as you rightly said, the amount has to be apportioned to the capitalization, and then the balance amount will be going to your revenue. So that's the principle I said, avoidable cost concept. You have to first apportion to the capitalization that you are doing or the expansion that you are doing. Of course, it should qualify as those qualifying assets and the borrowing cost incurred, and the balance only goes to your P&L. That's something which we covered in our discussion in detail.
Okay. Sir, we have one more question. What about borrowing cost due to delay in capitalization of specially construction assets, where delay is avoidable by the management?
Delay is avoidable by the management. What do you mean by that? So let me just think loudly of what it says. So see, as long as it's a delay which is in the normal course, I don't think that really excludes you from capitalizing borrowing costs. But a delay which is, and we saw our last example, if it's a delay which is being done in terms of its utilization, but the asset is ready, in that case, you'll have to set the capitalization of borrowing cost. But if it's a general delay which has happened over the tenure of maybe 10-15% time, I think that in that process you could continue capitalizing the borrowing cost. That shouldn't be an issue.
Okay. Thank you, sir. So one last question is there. Whether the loan drawn down through an external commercial borrowing can be invested in term deposits, and whether its interest can be netted off against interest of ECB?
So again, I think this is more of a legal determination, and I'm not a legal expert. But my understanding is an ECB comes with its specific conditions, how you use it and how you can disburse it. So as long as you are in those rules, and if you're earning interest and that ECB has been taken for a specific purpose, you can net it off. But you'll have to very strictly go by and abide by the rules by which the ECB has been given to you.
Okay. So thank you very much, sir, for throwing light on the topic and sharing your enlightening words. And now we have second faculty for the day, CA Jayant Kokle. Let me introduce sir. CA Jayant Kokle is presently working as director of PTC India Limited and a mutual fund trustee company. Formerly, he served as government-nominated ID of Syndicate Bank and also chairman audit committee. He also served as audit committee member of LIC Mutual Fund AMC Limited. He was elected as a Central Council member of ICAI for the last 12 years from 2001 to 2013, and he served as numerous capacities. Prior to this, he was chairman of WIRC of ICAI in 1998 and secretary in 1997, and WIRC member for 6 years. He also served as joint secretary of CTC and presently managing council member. He has been faculty for C&AG's Indian Audit and Accountant Service Academy at Shimla and Mumbai, National Academy of Direct Taxes and Yashada, all training institutes for government officers. He has been visiting faculty for courses conducted by IIM Bangalore, JBIMS Jamnalal Bajaj Institute of Management Studies and IEAS Management Institute of BKC Mumbai. He has delivered lectures across the country for ICAI, BCAS and prominent national publications on subject of taxes, accounting, auditing and law and ethics. He has authored 2 publications also. I welcome you, sir.
Yeah. 1 second. Yes, good morning and good afternoon rather. And thank you, Pratik, for your talk. Yeah, let me just and a warm welcome to everybody else who's logged in. Of course, as I often say in my presentations, if you have a question, of course, some of you are possibly sending it directly to the administrator or webcast manager. But if you feel something immediately relevant to what I'm speaking about, feel free to put it on the chat box. I'll try and keep some attention on that so that I don't miss out something which is immediately relevant. And we will keep some time at the end also for question answer, as Pratik has done. Let me just start with the screen share so that I put you on to the specific email specific screen that I am intending to share with you. I've got too many windows open. Let me just close some of them. Because in all the windows, I'm not finding my PPT. One second, some technology issues. Let me just close this and I'll. Finally, found it. Yeah, are you getting the screen share now?
Yes, sir. Yes, sir.
Okay, fine. So I'll just. Okay, thank you for the opportunity to share some knowledge and give me an opportunity also to learn something new, because sometimes your own knowledge gets outdated. So the second session we are going to deal with is accounting for investments. This is by way of a guidance note. Now, normally we have, and I think Pratik took up one of the ASLB, that is a local body standard. But on accounting for investments, we have deliberately and consciously not gone for a specific accounting standard. The reason being that the committee deliberated, strictly speaking, just to sort of get you on the same, on par with what Pratik was speaking about in the earlier session. While we are more on par with IPSAS and Ind AS, or rather I would say IFRS, which are the fundamentals that we use for all the accounting standards that we now come out with. However, after deliberation in the committee, I may inform you that strictly speaking, the Ind AS that is applicable is investment property. I think that is Ind AS 38 or some 40 if I'm not mistaken. So Ind AS 40 would be the normal thing. It would be read along with Ind AS 16, which deals with assets, etc. However, given the state and a couple of questions that were asked, and I will try and touch upon some of the topics that were asked to Pratik at the end, that why is it that they are not following such reporting norms, etc. All of you will be aware that insofar as government accounting is concerned and the proper reporting and disclosure is concerned, we are still at a very early stage. So we are, that means the concept as has been there in many of the EU countries, in the Australia, New Zealand sort of countries, the Asia Pacific countries, including Singapore, we have not developed to that extent in our presentation of government accounts. And therefore, what the committee at its deliberations felt was that instead of prescribing a standard for this, it might be better to simplify it in a manner that most of the local bodies will be able to first migrate to following the guidance note, and then, of course, with due inputs from chartered accountants. That aspect also I will touch upon later. And of course, then move on to actual compliance with ASLB. So at the moment, the committee of the institute has not prescribed an investment property standard, because that would then override this guidance note. And so far as the Ind AS 16 is concerned, we are not so much onto that area, because that is property, plant, equipment. So we will stick currently to the guidance note for investments. So let's look at what really this guidance note covers. And having given this background, let me also say that the guidance note is practically like a simplified standard, because it's not that we wanted to make a departure from the standard, but we wanted to provide significant relaxations when we are putting this standard in place. when we are putting this guidance note in place. So the idea was we start by putting in the same structure, but in terms of what compliance is required, we simplify the concept. So if you see the structure of the guidance note, which I have put up for your consideration on this slide, which is the first one, that it puts in, as you will find in all standards, it puts in the definitions first. It puts in inclusions and exclusions. So what is included? We'll go through each of these items. Then it deals with the three fundamentals that are always there in all our standards. So it deals with recognition, measurement, and disclosure. These are the three underlying essentials in any accounting standard that you will see, whether it is in Ind AS, AS, etc., and also IPSAS and ASLB. So the recognition, measurement, disclosure forms the core. And then finally, I will touch upon, as a practical thing, what records are to be maintained by the local body or the, I sometimes will use the word ULB because that is so much part of it, but we include all local bodies, whether it is Panchayati Raj institutions, smaller councils, etc., urban, semi-urban, all of those when we talk of local bodies. So with that, let me move. We'll go step by step. We'll not go much on the definitions because when we come to the relevant part like investment, short-term, long-term, we will deal with it over there. But first, let's look at what is covered and what is not covered. So let's take a look at that. Okay, so we are fundamentally looking at the objective, which is to provide guidance on how you account for investments. Now, that's a fairly simple thing for all chartered accountants. As I said, financial instrument standard is very complex. In IPSAS also there are, because foreign municipal bodies also overseas and internationally, they have got large amount of funds, their populations are lesser, their amount of free float is available, they've got treasury also, just like some of our state governments. So therefore they have these concepts of financial instruments, etc. Whereas in India, all that may not be necessary because most of our municipal bodies are living from hand to mouth. Even large bodies like Bombay Municipal Corporation, etc., don't have too many free funds, so to say. Although they have got huge amount of funds coming in and going out, the amount of float which could be used for something like a treasury management is usually not there, not a long-term float. Therefore, to that extent, this is more conceptual, it is more for you to understand and see how it is more in line with the overall IPSAS and ASLB. But at the same time, we are talking only of certain areas. So fundamentally, what are we talking about? We are talking about accounting for investments, which means, like in investment property, it means A, assets that are not held for operational purposes. That means the investments that we make are not intended. There can be investments intended for operational use. I will give you some examples of that. Or for rendering services. So those are the second category. Both these categories are, why I have marked them in red, is that they are outside the scope of this guidance note. So anything which is held for operational purposes, any investment which is held for operational purposes or for rendering services are both not forming part of this. Now, what could be an example of an asset held for operational purposes? Various municipal bodies hold investments in joint venture enterprises. Like there will be, say, Delhi Municipal Corporation would have something like an investment in a Jal Board or Jal Nigam, or Mumbai Municipal Corporation. Those who are familiar with it will know that most of the water that is supplied to the city of Mumbai comes from outside areas. That means they are covered in local bodies, not even major civic bodies. It comes from places like Tansa Lake, and there are lakes outside Mumbai near Nashik, Igatpuri, etc., which are owned by different local bodies. Now, if Mumbai is to supply its huge population, they have to have certain funding to make those dams and lakes operational, maintained well, etc. Whereas the body that is having the jurisdiction over that hardly has any funds. So what has been done is that for Mumbai, Thana, Kalyan, Dombivli, 3 corporations, possibly one more also, they have put together their funds and invested in a joint venture, which is a separate company, maybe a Section 8 company, in which Mumbai Municipal Corporation owns certain amount of shares, and therefore it owns controlling interest in that. Now, that is a company which is held not for investment purposes, not for appreciation in value, but to provide for operational ease. That means because it enables Mumbai Municipal Corporation to get its own water supply from one of its companies, which is primarily controlled by it, but the jurisdiction, that geographical area falls outside the jurisdiction of Mumbai Municipal Corporation. So that is an operational investment, not an investment held for the sake of return. So primary characteristic as in investment property is that investment property or investments which are held for the sake of return are those that are covered by this guidance note. Okay. Or when you say return, it could also mean that they are held in order to enable you to park funds over there, because you may get, as somebody mentioned, you may get international financing and they may not allow in very many tranches. They may say 3 tranches or 4 tranches. So the first tranche itself, by the time your project starts becoming functional, you may have a few crores of rupees, which is not immediately required in the next 3 months. So you may want to invest that in whether it is in permitted government bonds, etc. And those become investment or investment properties under the normal dispensation of the Ind AS. So those are the sort of investments. This is one aspect. Or for rendering services. Operational purposes or rendering services, you may also have certain things like you may invest in a company that is owning a fleet of road cleaning vehicles or something like that, because you may be getting separate funding, you may form a separate entity. Those vehicles like garbage collection, excavation, because it is not just the garbage collection that you see over here. But where it is dumped, you require some heavy equipment to enable the garbage to be sort of stacked in a proper manner, see that it turns into compost and other things. So they may have separate, and they may sell their compost, because ultimately, when you dump so much garbage at some place, there must be some way that you can make benefit out of it. So municipal bodies will be encouraged to actually invest in companies which will have the service of collection of garbage, storage and utilization. That garbage could be used to generate compost, etc. And then that compost could very well be sold as fertilizer to various other units, which could generate a profit. So it is primarily that cannot fall within the objectives of a municipal body, but it could form part of the objects of a company floated by.
Sir, I think there is signal issue at your end.
Oh, okay.
Your voice is breaking, sir.
Okay, let me see. I'll try and switch to another channel. One moment.
Yeah.
Or I could do one thing. I'll first switch off the video.
Now it's clear, sir. Now it's clear, sir.
But I'll switch off my video. It's not necessary. So what will happen is that perhaps you will get better bandwidth on that. One moment.
Yes, sir. Yes, sir.
Yeah. Are you getting the image? But only thing is that screen sharing is on now, madam?
Yes, sir.
And voice is better?
Yes, sir.
Okay, fine. So as I was mentioning, so you will have situations where assets are held. That means these assets might be financial assets in the sense that they are shares in some joint venture, shares in a company, etc., which are not held either for operational or for render. That means which are held for operational or rendering services. Those are outside the scope of this guidance note. So those go out. That is all these, and then of course assets like fixed assets, current assets, etc., which are not according to this, are also not investments. So that also goes out. Then the third category that actually goes out is assets held as stock in trade. So those are not investments, even though they may amount to something. You may be actually holding some nature of assets which are sort of transferred by you to various entities under your control. Those are certainly not investment, although at times they may give you some sort of a return because you purchase in bulk quantity. You may get some you may get some sort of cash discounts on that, or you may get some cash back on that. That's not an investment. It is something which is happening because you are, say, purchasing a lot of saline bottles or bandages or whatever for the municipal hospitals. So once you go into that, so typically we define everything as what is not covered. We first say chartered accountants are famous for that. So when we understand investments, we define it to say that investments are something that are expected to give you some return which are not held. So some return is expected, whether it is by way of interest, whether it is by way of dividends, some appreciation in value, any of this. But it is not for operational or rendering services, and it is not a fixed asset or current asset, etc., in the sense that other current assets, that is stock and trade, etc. So those are all excluded. Those constitute investment. Now, what the guidance note says is that investments are then classified by two categories. One is by their nature and one is by their realizability. So the definitions part, which I have not gone into separately, but when we are covering this, I will just, as I am mentioning just now, short term has got two characteristics, which of course to CAs that is quite clear. A, that they are readily realizable, and B, that they are intended to be held for more than 12 months. So at least the intention. Sometimes you may sell them off earlier. You may have shares of certain cooperative banks also required to be held for some practical reasons, and so on. So all these are included in the definition. So investments, short-term investment, long-term investments. Then I've given the definitions which are included. So fair value, market value, etc., are also defined in the guidance note. I will not go into that because as we discuss fair value, market value, we will come to that. So let's look at the classification that the guidance note speaks of. First is that the investment classification has to be by maturity profile. So short-term and long-term. Long-term is very simple. What is not short-term is long-term. So what is short-term? Realizable, as I said in the previous slide, if they are readily realizable. So there is reasonable liquidity. So all that will come into reasonably liquid and intended not to be held for more than 12 months. So you could have bank deposits which are short-term, 3 months, 6 months, 9 months deposits. You could have various other items, other investments in government securities. If you are investing, let's say, in state government bonds, you may want to have those as long-term investments. You may invest them because state government puts that as a condition to give you certain loans, etc. Sometimes there is some financial structuring within state government also. So sometimes these conditions are put. Or sometimes an external borrower may also put a condition that you need to own so much percent, 10% of your borrowing needs to be always put in government bonds. So at least 10% liquidity is assured, something of that sort. But you are not intending to sell them, then that goes into long-term category. So why is this important? Because how your disclosure works, you will require this sort of classification in order to enable proper disclosure. Now, mind you, the word not intended to be realized. So it goes with intent and not with the face value. So there may be certain investments which may have a life. Let us say you are investing in certain, say, non-convertible debentures or electricity bonds, etc. The bonds may have a tenure of, say, 10 years, 5 years or thereabouts. You may be intending to invest them only for the short term because you want to start certain, say, works on your water processing facilities, but that can't start until after the monsoon, for example. So you have got a 3-month float, which you can't start even if you've got funds from your international financiers. You will tell them that until July, until the major rains are over, we can't start this work. So the funds may have been received by you, but you may not be in a position to utilize it. So May, June and July, you may want to put the funds into some short-term investments. Those could be bonds having 5-year maturity, but what is your intent? So it goes with intent. So please take care of that. And there, of course, there are long-term. So this is one item. So maturity profile. However, maturity profile does not necessarily define whether it is short-term, long-term. It is an indicator. So be clear on that. Then, of course, there is the other type of classification which is required for all securities. There are various items that you may invest in, even local bodies in India, although there are numerous restrictions, and the last category I will mention. But generally, investment in central and state government securities is permitted. Treasury bills is permitted. If you are looking at selling off that investment in 3 months' time or so, you may want to put it in treasury bills instead of government bonds. It all depends, because treasury bills might have a shorter period of maturity and so on. So there may be no cost, although the return may be lower, the cost of acquisition and disposal may also be lower, which may make treasury bills at times more attractive. So there you define by the types. Then there are bank deposits, which of course everybody has. There are certain debentures or bonds. There are mutual fund investments that may be permitted. Some mutual funds, like I think LIC mutual fund, could be a permitted security, and so on. So there are certain mutual funds that are there which may also be there, and certain commercial papers. Again, I believe that certain commercial papers such as public sector enterprises like ONGC, etc., their commercial papers are at times permitted for certain types of bodies. So let's say municipal council, municipal corporation of say Hyderabad, Secunderabad, Bangalore, they may be permitted. And then if there is some bond which is available, or some commercial paper which is giving you good yield, you may want to invest in that. So that is the second. And the third, equity and preference shares, other tradable investments. Very rarely municipal bodies, local bodies will have authority to invest in these, but these are mentioned hypothetically. If the government wants to relax, they can relax by way of a notification. So certain things may become permitted at any time. So for completeness, I have just put the block over there, that equity and preference shares, etc. But in practice, you will rarely find this in application. So once you say that, okay, we have identified what are investments, we have identified what category they fall into, and the classification is two-way. So something which is short-term will also have a categorization that short-term bank deposits could be there, long-term also could be bank deposits or non-convertible debentures, etc. So this is a two-way classification. Okay, we will come to that in the disclosure part again. Having identified that, the guidance note deals with basically the, as I said, as all standards deal with, you deal with recognition. So we have touched upon what do you recognize, what do you not recognize. So we have said that fixed assets are not recognized as investments. Certain stock and trade is not recognized as investment, and so on. But having done the recognition, the point of recognition, when do you recognize it? At the point of acquisition, whether it is when you transfer, etc. Those are details which are common across all our standards, whether it is Ind AS, AS or IPSAS. So the same things will apply. But what you recognize, we have dealt with. After recognition, the next issue that every standard and also this guidance note deals with is initial measurement. So because you have a cost for acquisition, so how do you recognize the cost? So you measure what is the cost, quantify it. When you say measure means, the standard always requires you that you quantify what is my cost. So at the initial measurement, you determine what is that cost at the point of acquisition. So because we are generally on historical cost convention, all of us are aware. So even if you are implementing this system at a subsequent point of time, you will have to go back to the initial measurement concept and see what was the cost at the time of acquisition. Okay. So you will obviously say, okay, cost will be purchase price, or if they are granted by the government, those are separate items that we'll come to. But by and large, these will be purchased and acquired, like bank deposits, etc. There is no purchase, you deposit money with the bank. So you know that the cost is the amount of money that you put in. Then any other directly attributable cost, so whether it is government bonds, whether it is any other convertible, non-convertible debentures, etc., which are permitted, or even in case of, say, LIC mutual fund or some such thing, then you will have a purchase price, and then any other directly attributable cost. So what are the directly attributable costs? Again, to CAs: brokerage, transfer fee, stamp duty, other taxes, duties, your if you wish to, because you are dealing in large volumes, because it could be in crores or rupees, the fees for your demat accounts, etc., which are paid regularly, you may want to apportion and so on. So, or transaction fees over there. All this will become your directly attributable cost. What could be your indirectly attributable cost? So directly and indirectly. Indirectly could be that suppose you purchase a Government of India bond. The Government of India pays interest on fixed dates. So let's say it is on, say, 5th of April and 5th of October. So if that is the case, suppose you decide to buy the bond because you've got excess liquidity only in the month of January or February. So you will get a bond on the market through any of the merchant bankers who are, or primary dealers, etc., who are authorized to then also sell to you through the broker. You would get that at a inclusive of interest cost. So it could be inclusive of interest. So pro rata interest would be adjusted. Now that cost which is quoted, they will say that, okay, today's cost is, let's say, for a 10,000 rupee face value bond, the cost today is 10,064 rupees. Now that's 64 or 360, 10,364 or whatever the cost may be. That could include an element of 360 rupees of interest and 4 rupees of charges that the other person is levying, or his own buying and selling differential. All that to you is cost, but the interest has also to be adjusted, because ultimately you are going to get the interest. So at that date, the accrued rate of interest, so let's say that it's a 7% government bond. So you have to calculate that from the date that interest was last paid, let us say 4th of October or 5th of October, 5th of October to 5th of January. So you have November, December, Jan, 3 months. Interest will be paid only after 6 months. So at 7% on the face value, whatever is the figure. So on 10,000 rupees, your figure for this will be 7,000 rupees for a year. For 3 months, you will calculate and adjust accordingly in the value. It may turn out that your actual direct cost is at a discount from 10,000 rupees, but you are paying the incremental amount because of accrued interest, which is embedded. But that interest was never due to you. It will be income of the seller. So your cost will be, to the extent that your cost will be adjusted to the quantum of interest, which will be adjusted over there. And that element will be adjusted against interest, let's say paid in advance, against which you will get interest for the entire 6 months, although your investment is only taken place from January. So January to February, March, April, you will get 3 months interest, which you will adjust. So all these adjustments you will have to do. There could also be a premium or discount for certain types of bonds, like some bonds which are paying tax-free interest. You may be willing to pay a premium. So actually the rate in the market may be X, but you may be willing to pay a premium. So your cost may go higher. Or because the cost may be increased because certain bonds don't carry an obligation to deduct TDS. And many municipal bodies find it attractive to invest in bonds which are not having TDS, because they often don't file their own returns. And otherwise the TDS element is lost so far as they are concerned. So these are adjustments that you will make at the point of initial recognition, and then account for the investment at the appropriate value. Then there are, of course, two different situations envisaged in the guidance note. If it is by issue of securities, so that also could be one method, that you are issuing certain securities and acquiring certain investment. So that is a method which is not common. But if that is so, means I have not frankly come across any situations in India where by issue of securities you are getting other investments. But if that happens, the fair value, which need not necessarily be the nominal or par value of the securities that you receive, could become the basis of valuation of the investment. So your initial cost would be measured on that basis. So that is so far as issue of securities. As I said, it is provided in the guidance note, but it is not something that I have encountered. There is also the last category, which is also touched upon by the guidance note, that if it is acquired by exchange for another asset. So perhaps, say for example, I spoke about investment in a company which is handling the water supply. So let's say that there is a 4M, I'm just giving a hypothetical name, 4M water supply company. Okay, so 4M is 4 municipal bodies have combined together. Each of them has acquired different shares depending on their assured water supply requirements. What would happen? That earlier also Bombay Municipal Corporation may have actually invested, let us say, in building the dam. Now that dam would become the property of that company, and so on. So what Bombay Municipal Corporation or Kalyan Dombivli or Thane Municipal Corporation may do, that they may all have assets at various locations for enabling this water supply. Those assets would also be transferred to that company that they set up. So there they would say that, okay, the value of my dam is say 40 crore rupees. In return, what I'm going to get is shares worth say 40 crores of rupees in the joint venture company that we have set up along with other bodies. Or they may say that I will take pro rata, I will take equity shares of say 10 crore rupees instead of 40 crores. I will take the shares worth 10 crores because the book value of the asset may be in fact much lesser. Book value of the dam may be only 2 crore rupees. But it is valued and taken that everybody takes their values at 1/4 the value. These sort of deals are reached between various municipal bodies. They may take it in exchange of other asset, but the idea is that what is the fair value of the asset given up? So let's say the dam at a replacement value has a value of 40 crores. So what happens is, you may agree that in return, I will take up shares in the joint venture company and everybody takes up shares equivalent to 1/4 the value of assets transferred. Does that mean that the asset value has gone down? Answer is no. You have surrendered a fair value asset of the dam having a value of 40 crores. You have acquired equity shares worth 10 crore rupees, but the shares will be shown at a fair value of 40 crores as your investment because the asset surrendered by you was worth that much. So whatever is more self-evident, because the value of the shares in that company is virtually worth nothing. Whatever is the face value is the value, barring any other information. But if you have transferred an asset worth 40 crore rupees, then that becomes the value of the investment. So that is how the standard also prescribes it. Not the standard, sorry, the guidance note. I keep referring to standard. So, okay. So broadly, what the guidance note itself, this table I have practically copied. I've just modified a few sentence words here and there to make it more concise. But otherwise, this table is given in the standard itself. So it says what each of the items will be. So government securities, as I said, directly attributable cost. Interest-bearing investment, you adjust it for the interest or dividend portion, that is for pre-acquisition period, whatever is there, you follow the method that you are following normally. Equity or preference shares, I have also mentioned how that is to be taken. Purchase cost plus directly attributable, same for bonds, debentures. Exchange of securities, we already dealt with in detail. And exchange of another asset is dealt with in even more detail. Exchange of securities, as I said, is something which I have not encountered in practice. So perhaps we need not bother too much about it. So having dealt with your initial measurement, now the question arises that either you are on historical cost or you are on fair value. So far as investment is concerned, what is mentioned, and I've given the preferred method or alternate method, but as the world is moving towards fair value, and also because municipal bodies want to raise funds from external sources, including banks, including foreign institutional investors, etc., these people are willing to take certain investments in municipal bond market, etc. So they want to have a strong balance sheet. Now, if you show at historical cost, perhaps it may not be the best method. So what the guidance note recommends, after a lot of deliberation, there were different shades of opinion on this, but what has been given is a preferred method and an optional method. The preferred method is to carry investments at lower of cost or fair value taken individually and then aggregated. So if you're taking lower of cost or fair value, then you're practically going to be at cost except for loss-making items, which you may be saddled with either because it was part of your acquisition of certain assets, etc. But lower of the two, that is a standard thing. I don't have to explain to CS. The other option, they may be categorized at lower of cost or fair value computed category-wise. So there may be certain investments which have gone down. There may be certain that have appreciated. If you see the first one that I have referred to, it says that taken individually and then aggregated. So simple enough, for each investment, you put a column in Excel and say that, okay, this is my cost, this is my current value, take lower of the two into third column and then aggregate that. But a second option is given that you want to aggregate because if there are large investments, which frankly, in most municipal bodies, it does not happen except for government bonds and treasury bonds, which might be held. Generally, their value of investment is not large. So if you want to calculate category-wise, that option is also given since this is not a standard and in a guidance note, we are permitted to allow options. So that is why one of the important characteristics in this is that you can carry it at the cost or fair value computed category-wise. So all equity shares to be taken together, convertible debentures to be taken together. Government bonds may face ups and downs, but some may gain, some may lose. So you net out that and then take the difference. Then, as is our traditional principle, unlike the fair value issue that often comes up, the guidance note sticks to the more orthodox valuation that any decline in fair value is to be accounted for in the books, in the sense that you make a provision or you decline the value in the books, cost or fair value. If it goes below cost, you make the provision for the decline or mark the investment down to that extent. However, if subsequently the fair value of that goes up, then you are allowed to make a reversal to the extent that you have already depreciated. So say government bonds of 10,000, you purchased at 10,030, but now the value has come to 9,920 or 980. So you will make a decline of 50 rupees per bond of 10,000. You will account for that. But later on the bond appreciates from having made a provision at 9,980. You made a provision of 50 rupees, but now the bond has gone to 10,010 because certain yields have gone down presently. But if we see a change in the yield curve, we may have that situation. In such a situation, since you had already provided 50 rupees, now it has appreciated by 30 rupees. So you may reverse to the extent of 30 so that your P&L or income expenditure has taken a hit of a net of 20 rupees only after the reversal. But when you are making the reversal, please note that you are not allowed to book gains. You are allowed to only reverse what has been written off or provided for in the past. So this was in regard to short term. Sorry, I forgot to mention that what we were referring to, the title says that this is in reference to short term investments. What happens when we go to long term investments? Long term, since temporary fluctuations would not affect, therefore the principle as is always is that they are carried at cost of investment. However, there is a clause that when there is a decline other than temporary in nature. So if you see that there is a fundamental change because certain restrictions have been brought in, certain market situations have changed, if there is a more pervasive decline in value, then of course you will be required to provide for that. So if it can be stated that it is actually that I'm going to hold this to maturity, my whole objective is to hold to maturity, then the decline of temporary nature in another 5 years, I'm going to get full face value. So why should I provide the decline, even though the share or the bond market has taken the 10,000 rupee bond to 9,980. You may not want to mark that 20 rupees decline. It will, of course, come in your disclosure, but you may not want to make a provision for that because RBI is itself guaranteed that they will pay the bond on maturity at 10,000 rupees. So then that decline can be considered as temporary in nature. Temporary is a very relative word. I have therefore highlighted. What is meaning of other than temporary needs to be understood in the context of the classification of the investment. That means, are you treating it as long-term, short-term, etc.? Then the concept of other than temporary can change. But basically, unless there is a other than temporary decline, that means if there is a short-term decline, no need to provide for long-term investments. If there is a what appears to be more or less a permanent decline, there you may be required to provide. The rule in the guidance note is very clear that here you can't go aggregate. Here you have to go individually. So each individual bond, there are instances where certain, say, 1983 6% bonds are rated at a premium, and 1971 30-year bonds that are there, or whatever, 1991 30-year bonds, 1990 bonds will be having a negative. 1995 bonds might be at a premium for various reasons. Market knows best. But the carrying amount has to be determined not by setting off these two, it has to be determined by each investment. So one premium, other discount can't be just set off just like that. You have to take the netting out of all the figures after individually calculating the gain or loss. So this is the principle so far as the long-term investments are concerned. And of course, whatever is the decline in fair value, like I gave in the previous example, I said that, okay, on a government bond, you might have to make a provision for 50 rupees on each bond because the value has now gone to 9,980 from the value that you purchased it at. So such declines in value, or in a later situation, you want to reverse 30, all these are to be included in the income expenditure statement. So you don't just account for it through reserves and directly to balance sheet. That is not the correct treatment. It must be routed through the income expenditure account. So that you have to keep in mind that for long-term assets, this is long-term investments, this is the rule that applies. Then, of course, there is the issue, there is a provision in the guidance note for reclassification and disposal. When we say reclassification, it is assets held for sale, investments held for sale, etc. However, that situation generally does not arise in India. Therefore, although the guidance note touches upon it for sake of completion, I am not going to touch upon it because reclassification hardly ever occurs. Those of you who are doing bank audits will be aware that you can held to maturity and short term and so on, those classifications can be changed even in banks. So you know the rules that RBI has prescribed. You can do it once in a year, beginning of the year. Sometimes for certain categories, it is twice in a year and so on. So those same rules would apply. I am not getting into that. I am only going to talk about disposal because you've got recognition of original cost, you've got subsequent recording of the cost. And then if you are disposing of the investment, which eventually you may want to do at some stage, whether in the short term or in the long term, you have to account for that disposal. So how do you do that? That, of course, I have already mentioned that appreciation is not recognized. Appreciation in the sense increase in value. appreciation. Chartered accountants don't generally appreciate anything. So that's a different matter. But the increase in value not to be recognized, whether short-term or long-term instruments, but in the event of disposal, then the difference between carrying amount and the disposal proceeds has to be recognized through the income expenditure statement. Again, quite fundamental so far as we are concerned. It has to be done. Disposal will result in certain gain or loss. It has to be taken net of all expenses. That goes without saying. Commission, brokerage has to be adjusted. So your gain or loss is computed on the basis that what is your actual realizable value. The rest of it has to be written off in that situation if you have disposed of the whole. If you have disposed of part of it, then of course it will be at the average carrying value. So let's say you acquired government bonds initially at 10,030, then at 10,020, then at 9,980. So you have to derive based on your cost, preferably weighted average cost. Otherwise, average cost in case you don't have the weighted average system. But in any case, average cost has to be considered, not FIFO method as is often adopted for tax purposes in case of individuals investing in shares. So for accounting purposes, it will always be the average cost, and that average, according to me, will always be a moving average. So as you make further purchases, your average cost will change. And as you make a sale, your average cost will be used, taking all the cost consideration that are there till that date. And then only you will determine your gain or loss. So disposal is again a fairly simple proposition. Then towards the end of what I intend to present, because I'll leave about 5-10 minutes for questions, what happens is that where investments are maintained in specific funds, now you will find that increasingly specific funds are being created. Like in order to give assurance to, say, somebody investing in, although I know metro is not directly controlled by municipal body, but let's say a municipal body develops some rapid transport corridor, see a bus corridor that goes without any other traffic. So for such a thing, a specific earmark fund may be created that out of my vehicle taxes, that means they give an assurance to the foreign lender. Foreign lender says, okay, we'll finance you to the extent of 50% of your cost, and which you pay over 25 years. The balance 50% has to come out of collections of vehicle taxes, for example. So the lender will sometimes say that your vehicle taxes tend to get used for anything, for medical, education, whatever. No, we want you to create a earmarked fund. So 50% of your earmarked fund will go towards, say, developing rapid transport corridor in a urban environment. If such a thing is happening and you have got investments in that, say, rapid transport fund, let's call it, for example. Now that investment could be held for a certain period of time, and when your actual expenses and bills for the contractors for developing that or earmarking the roads and all that, when that expenditure happens, you may liquidate some of those investments. So when that happens, or until that happens, the same principle as applies to all fund accounting. Again, all chartered accountants would know this, but sometimes what is our 11th standard syllabus, we tend to forget when we are actually practicing CS. So all income from specific fund should be credited to the specific fund, not directly, but by passing it through the income expenditure. So you will take, let's say, my investment from this rapid transport corridor is yielding me a revenue of 5 lakh rupees as interest income, okay, on bonds that I've invested in. So 5 lakhs will come to my interest income account in the income expenditure. Correspondingly, I will make a transfer through appropriation, although nowadays that concept above the line, below the line is not recognized so much. But so far as municipal bodies is concerned, through fund accounting, you can certainly say, so apportion 100% of revenue of specific fund investments. So that will go to the debit of your income expenditure account. So effectively, it has zero impact on your income expenditure. That amount gets credited to the fund account, but it is routed through the income expenditure account. That is so far as income. If there is a profit on disposal, similarly, even though routed through the income expenditure, it will ultimately get credited if there is a profit. That profit will also go to the fund, unless it's explicitly provided otherwise. That profit would go to the fund. And similarly, if there is a loss, it will go and hit the fund and it will not hit the main municipal body accounts. Okay. And third is that if there is a diminution in value, that is, if it's long-term investment, it's other than temporary decline, you want to take or you need to take a hit, then it will of course go to the, not to the profit and loss, it will go to the specific fund that has got depleted. So to the extent that you started off a fund with say 10 crore rupees in it and corresponding bank balances and investments, but if certain investments are sold or compulsorily encashed or whatever, and you make a deficit in it, then to that extent your 10 crore fund will become 9 crore, 98 lakhs, something like that. 2 lakhs you may take a hit because of diminution in value, and that will affect the fund and not the main income expenditure. So having said that, let me just cover two last areas that I need to cover, and then we can have a couple of questions that we need to have. First is that what is the information to be disclosed? Like in case of municipal bodies, first and foremost, you must keep in mind that various state regulations and legislation will prescribe what is required. So you have to obviously follow that. But as a general rule, in absence of anything specific, whatever is prescribed in the guidance note, also CA should insist that the local bodies should follow that. And what are these? These are again simple things. Accounting policy for determining carrying value of investments. We already discussed how you will be determining cost, etc. Carrying value of that has to be disclosed. So classification, as I said, that is required to be disclosed. You have to classify it as short-term, long-term, and also classify it according to nature of investment. So you may classify saying that I've got government bonds X amount, treasury bills Y amount, and let's say mutual fund investments Z amount, and so on. So you have to give that classification as you give in the case of various investment companies, etc. Then aggregate amount of quoted and unquoted investment. Below that, you have to give the breakup that how much is unquoted, because that gives an indication of your liquidity level. So, and in case of quoted equity, you have to give the aggregate market value as a disclosure. So as I said, if you got losses or declines in value, you will automatically book them. And there you can make a statement saying that the decline has been fully provided for. But if you got an increase in value, you have to show that increase over here, giving the aggregate market value. So you acquired at an average cost of 10,015 rupees, let's say 10015. But your market value of that investment is now today at 10025. So you have made a gain of 10 rupees. So you have to disclose that I have got a gain as per current market values of 10, which is unencashed. So this is a book gain, which is neither recorded in the books, but your disclosure in the notes has to be there. Then coming to income expenditure, of course, interest dividends from investments are to be separately shown. Interest dividends from earmarked funds are also to be separately shown. If there is any restrictions on right of ownership or of realizability or remittance of income, etc., that has to be disclosed. So where will such restrictions come in? Sometimes say you have taken the shares in this, I'll use the same example so as not to deviate. Say in the JAL board, you have taken say 60% share. The parties have agreed that none of the parties is entitled to dispose of that share for at least a period of 25 years. Why is that? Because they don't want any private party to come in profit on the sale of water. That is a very valuable resource. So there may be a condition that you can't transfer the shares for 25 years. So that may impact your realizable value, etc. So all that has to be disclosed. Also, if you have made provision, as I spoke about increase, you have to also make a separate disclosure as to aggregate diminution in value that you have recognized. If there is something unrecognized, that also has to be mentioned. But ideally, the aggregate diminution in value you should recognize. If there is aggregate diminution in value of long-term investments which you consider are fundamentally temporary in nature, you may not have made a provision, but you have to make a disclosure as per this note. So that would be this other part of disclosure. Then amount recognized from appreciation by way of reversal, like that 30 rupees out of 50 rupees that I spoke to you earlier about, that you have to again make a separate disclosure. That is what the guidance note says. If there are reclassifications made, you have to make a disclosure. Again, as I said, it's not likely that there might be many reclassifications in India, so I'm not going into detail. But yes, the guidance note says that if you make a reclassification from long-term to short-term or short-term to held to maturity or long-term, then you will have to make a disclosure as to how you are treating it in future and what price you are transferring it at also gets affected. Since these are not very common issues, I have not gone into detail on that. And then, of course, other disclosures as required by the relevant governing statute, because various states have got various laws governing what you should disclose, and you have to obviously adhere to that. So I think that, okay, I've got, yes, last part, I had forgotten about this. This, of course, the guidance note gives only as an indicator. This is not a prescription, but in any case, a guidance note is also not mandatory in that sense. It is merely by way of a guidance, which you should ideally follow. So they have given the format of what details are to be captured in a register. They are fairly mundane and nothing unusual. I have given the details, so I'm sure the office will be able to share with you this, or I have copied it basically from the investment register details that we had formulated in the committee itself. So all the details one can think of. So name of the issuer. So suppose you've got, let's say, bonds issued by ONGC or Steel Authority of India. Then you will have the issuer's name, the certificate numbers, whether they are held in demat form, what is the value of investment made, what is the rate of interest on the bonds, date of maturity, date of... Actually, in case you have got proceeds, even though your investments may have matured, you still need to maintain the details in your register. So don't just wipe it out. Okay, so date of encashment or maturity of proceeds and date of receipt of the funds. So whether it was received with accompanying interest up to the last date, etc., all that has to be noted. Date of acquisition, date of realization obviously has to be there. Cost of acquisition. And if you're carrying that investment, then the carrying value as is disclosed in the available balance sheet on each year, or if it is now no longer carried, the disposed value that you want to record. Also, you have to say not just the price of purchase, you have to give the breakup as per the format of what are the directly attributable costs that you have considered as part of price, so that there is absolute transparency. And the last but not the least, if you want to put in information in regard to whether there is any security or charge, like I gave you the example of a rapid transport corridor. So the foreign institutional investor may say that they have a charge on two things. They have a charge on the fund that is specifically created out of vehicle tax collected, and or they have a charge on the investments made from that pending utilization. So if you have acquired bonds or something, then those would be subject to a charge or lien, etc. Then that also has to be disclosed. So I think more or less on the dot we have finished, but I'm sure just a minute remaining. But perhaps we can take any questions, etc., that you may have for a few minutes, depending on the nature of questions that are there. So let me switch back. I'll stop sharing. And we can go back to my video so that in case there is some question, I could try and help you out. Yes, ma'am. You're on mute, madam. Madam, you're on mute.
Thank you very much, sir. So we have received one question from the member, like shares in smart city companies, how they should be treated.
Okay, so shares in smart city company, I presume that they are being held by the local body of the smart city. It's not taken as an investment per se. So it would be more in the nature of the strategic investment. It is not an investment falling within, I presume that it is held by a entity which is actually in the locality that the smart city is located. If that is the case, it does not meet the definition of investment that is dealt with this guidance note. It is a strategic investment. So that investment is taken always at cost and it is not adjusted for value. However, the disclosure requirements as given over here would also apply. So there is no harm in applying that they are held as strategic. Are there any restrictions for disposal, etc.? But otherwise, they don't normally fall. But let's say Mumbai Municipal Corporation acquires smart city shares in, say, Indore or Gujarat. Unlikely, but suppose they do. Then, of course, it will fall in the concept of investment, and then the entire guidance note, whether you are holding it for short term or for gains or for dividend receipts or appreciation, that would define your manner of treatment.
Thank you, sir.
So I'll just do one thing. There was one question which was Pratik. I didn't want to intervene, but which I often deal with because it's a very relevant question. I hope the person who asked that is still relevant, is available still online. Very quickly, because you asked the question that he answered, it's the chicken and egg question. Typically, how do you get work? And if you got this, but they always ask you for past experience, and therefore, how do you get work the first time? Very important and very relevant question. So I thought I'll answer it based on my experience. I have often been mentioning that you do not get large jobs for large assignments, but start off with these local bodies on smaller assignments. You can do bank reconciliation, you can do asset compilation assignments. Don't get into the full accounting all together, because that question will come, that what experience do you have in the past? So in order to acquire some experience in local bodies, start with the smaller assignments. Do fixed asset register compilation, do investment register updation, do inventory accounting, or do some bank reconciliation assignment. Once you can say that I have done work for A, B, C municipal bodies, then you are likely to get the larger work. So that was just an additional hint that I wanted to share with the participants. That's it.
Okay. Thanks a lot, sir. On behalf of the Committee on Public and Government Financial Management of the Institute of Chartered Accountants of India, I am extremely thankful to all the viewers of the webinar on mandates for chartered accountants working for local bodies. And I'm grateful to our senior faculties for sparing their valuable time to address the members. ICAI, as a partner in nation building, is making significant efforts to prescribe and support in implementation of high quality accrual accounting framework for local bodies that is at par with internationally accepted accounting and financial reporting standards for application by government at all the levels. This would enable local bodies to provide decision useful financial statements and financial information to the investors. The committee is also taking several steps to increase its visibility, approach, and reach amongst the government, be it central, state, or local self-government. The committee has extended a helping hand to all those who desired and expected it, especially in the area of accounting reforms and compliance mechanism. The certificate course on public finance and government accounting, which is being run by the committee, has been noticed by the policy makers, and state governments have started including it as criteria in assignment allocation. We are sure that with our efforts, chartered accountants would be playing a significant role in contributing towards financially empowering Indian citizens and creating a sustainable economy. I hope that you all must have been benefited from the deliberations of the webinar. I once again thank you all the participants for joining this webinar and making this program an interactive one. Thank you, sir.
Thank you. Thank you.